ahead. I'm joined from Sydney by Credit Suisse equity strategist Atul Lele. Atul, thank you very much indeed for joining us. Where are we with all this, and were you expecting this to some extent after the gains that we've had of late?
Look, we've certainly had a reasonable gain off the lows which we saw in early July. In terms of expecting all of this, well, we've got the combination of firstly slowing Chinese growth, which impacts the Australian mining sector. Secondly, we've got the impact of an economy in Australia which is going ex-stimulus or winding off a lot of that stimulus we had over the last year, which does obviously impact the domestically exposed sectors and in particular the bank sector. And of course you've got the concerns about the slowing US economy, which hits the broader market more generally. I think the important thing to note for investors though is a lot of this is already priced in. We knew we were heading into a slower growth period as we started cycling some stronger stimulus-led growth numbers from last year, and it's largely priced into the markets at the current point.
So do we just sort of tread water here for a while?
We are expecting volatility to continue, and it'll always be the case that when you are looking at some weaker growth numbers coming out, it's difficult for the market to rise in the face of that. As we start to move into the next leg of the global expansion, which we believe we'll start to see as we move into 2010, we should expect the market to break out of the range that we're in currently. So we're expecting not so much stable markets, obviously, but volatility around this level for the near term until we start to see growth numbers improve.
Yeah, broad-based, or do you have any particular industries you'd be looking at as perhaps bearing the brunt of it, and where would you be invested now to avoid that?
Look, it really comes down for investors to consider whether they believe there'll be a double-dip recession or not globally. We're firmly in the camp that believes that you will not see a double-dip recession, and as such you'll see economic growth resume as you start to move into next year. To be exposed to that economic growth, we obviously have a preference for the more cyclical sectors of the economy. We have a preference for mining and energy shares, and more of a preference for global cyclicals rather than domestic cyclicals here in the Australian market, simply because global growth and liquidity conditions are expected to be stronger over the next year than domestic growth and liquidity conditions.
Right. So, you know, where do you really stay right out of at the moment? What would you avoid like the plague?
In terms of what would be avoiding, or more what would be going underweight, would be the more defensive sectors, simply for two reasons. Firstly, our economic growth thesis is consistent with investing in cyclicals, and secondly, because the defensive areas of the market are simply more expensive as investors flock towards some of those safety trades while you're still seeing some of the mid-cycle slowdown type growth numbers coming out. So defensive sectors are what we'd be avoiding right now.
Atul, thanks a lot for joining us. Atul Lele there, he is a Credit Suisse equity strategist, just telling us about where you should be invested and just seeing more volatility on the horizon here for global indices.